Hi, I'm Thomas. Welcome again to Financial Institutions and Markets. Today we'll be discussing government borrowing. Let's begin with a comparison of deficit and debt. The deficit is the annual shortfall in a government's cash inflow versus cash outflow. That's typically what's happening with government financial situation. The opposite situation is also possible, although less common, a surplus, which is when annual inflows exceed annual outflows. And let's compare deficit to debt. Deficit is an annual measurement, an amount of activity over time, usually over a one-year period. Debt is a balance at a point in time, the balance of all unpaid deficit borrowing. So it's the accumulation of borrowings to cover deficits, less any debt paydown that has occurred over time. The deficit is an income statement kind of concept. It's a measure over a period of time, and debt is a balance sheet kind of concept. It's a measure at one point in time. Let's look at government deficits and some accounting concepts. When governments spend money, we can classify their expenditures into two categories. One is current expenditures. Those are the expenditures of running the country, running the government on a current basis during the year. And then there are capital expenditures. These are long-term investment type concepts such as infrastructure projects, roads, bridges, water systems, etc. Building schools would be a type of capital expenditure. Building government buildings would be a type of capital expenditure. So these two classifications are how we classify government's expenditures, and we can see or identify three sources of inflows, three sources of government funding. Tax receipts, taxes coming in from the citizens, borrowings on the part of the government, and selling assets, which would bring in cash flows as well. Some governments, as an additional source of funding, some governments receive grants. Typically, developing countries will have the opportunity to receive grants from multilateral organizations such as the World Bank or the International Monetary Fund, or from other governments directly. Let's look at the calculation of determining how much cash is a government going to need during the course of a particular period. Again, the typical measurement of time is 1 year. The public sector net cash requirement is made up of several components. We'll look at each of these individually and then see an example. Government current receipts. These are monies coming in that relate to tax receipts. Minus government current expenditures. These are the expenditures the government incurs for the current ongoing day-to-day, month-to-month, year-to-year activity of managing the government. The difference is the public sector current balance. Could be positive, could be negative. In addition to that, we have another source of inflow we described earlier, which is capital receipts. When we sell, we might have buildings that we sell. If we sell a building, that would be an inflow from a capital transaction, minus capital expenditures, the funds that go to bridges, to schools, to water infrastructure, etc. Those are long-term type of investments. Now we're at the public sector net borrowing. Two more components. There is another possible inflow. It's not common, but there is the possibility of privatization receipts. An organization, a corporation that is held by the government. If the government sells that entity, then there will be additional inflows to the government receipts from the privatization transaction, changing the company from a publicly held entity to an entity held by private individuals and other private entities. Minus government lending. It's possible that the government would lend some of its funds to other entities. And the final result is the public sector net cash requirement. This is what we are going to need to borrow in a particular period. And now we'll see an example of the public sector net cash requirement. In our case, this government has current receipts of $300, current expenditures of $350. So our first calculation, we have a negative current balance of $50. In addition, we bring in $30 from capital receipts, selling buildings, for example. We spend $80 in capital expenditure projects, bridges, schools, water infrastructure, etc. And now we're at the net borrowing number of $100. In addition, we have a privatization transaction or transactions that bring in $5, with loans to other entities, an outflow of $10. And our final result, the public sector net cash requirement, is a borrowing need of $105 for the period. Now let's look at investment in government debt. What is the incentive to invest in government debt, and who are the investors? The drivers of investing in government debt are attractive interest rates. Just like any investment, an attractive return will draw investors. And what makes an interest rate attractive is how the investor evaluates the risk-return combination. So for a strong government, that equates to low risk, and a lower interest rate will draw an investor as compared to a weak government that might be considered high risk and would need to offer a higher interest rate to draw investors. Secondly, economic growth. Economic growth in any economy creates additional assets for individuals and entities. And the additional assets is an opportunity for a government to receive additional investment. Additional assets are available from individuals and entities to invest into various opportunities, and some of those funds are going to end up in government debt investments. An investment into government debt means the investor provides funds to the government, and the government is the borrower. The government receives the funds and then has the obligation to repay both interest and eventually principal. Who invests in government debt? Individuals, banks, and international investors. When individuals invest in government debt, from a monetary analysis standpoint, there aren't monetary consequences. From the standpoint of monetary policy, there isn't a direct monetary consequence when individuals invest in debt. When the banking sector invests in debt, this results in an increase in the money supply. And recall from our previous discussions that when the money supply goes up, this tends to result in inflation if there is no matching increase in productivity. More money in the economy with no increase in products to buy usually results in inflation. And finally, international investors might invest in a government's debt, and this results in an inflow to the government of foreign currency. A government likes to have access to foreign currency, so this generally would be considered a favorable result to a government to have international investors buying the government's debt. When this gets to an extreme, it means that the government is to some extent beholden to foreign investors. As an example, the United States. China has a very, very large investment in U.S. government debt, and this in the U.S. government isn't considered to be a favorable situation. It creates a situation in which China's interest in the government is so strong, and the U.S. government's dependence on China's financing is so strong that it creates an unfavorable situation from an international relations perspective. We'll take a break here and come back shortly for part 2 of our lecture.